Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Academy Sports and Outdoors stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Academy Sports and Outdoors is a sporting goods retail chain. The company is headquartered in Katy, Texas and was founded in 1938. It went public in 2020 and currently trades on the NASDAQ. For 74 years, it was a privately held company owned by the Gochman family, until it was acquired in May 2011 by Kohlberg, Kravis, Roberts & Company. There are currently 259 locations across 16 states. It sells clothing, shoes, workout equipment, fishing supplies, guns, sporting equipment, backpacks, and much more. Let's get started with the model. This is a mid-cap company. 2.6 billion market cap. They're trading at $29 a share and they have 91 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had negative free cash flow in 2018, but it's been growing ever since, up to $970 million. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's pretty steady from 2018 to 2020, growing to over $300 million in 2021. Revenue is the sales for the company, and that was $4.8 billion in 2018, 19, and 20, then jumped way up to $5.7 billion in 2021. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example is the cost of labor at its retail stores. The difference between those two numbers is their gross profit, and that peaked in 2021 at $1.7 billion. Below that is operating expenses. Examples are marketing and depreciation. Then below that is operating income, which more than doubled from 2020 to 2021. Below that is the interest they pay in their debt, and they paid the least interest in 2021. It was over $100 million the prior 3 years. Below that is other income and expenses. This is usually impairments or write-offs. Then your pre-tax income, your taxes, and the bottom line of the income statement is their net income. And that really shot up in 2021. COVID helped this company because their sales were really strong. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. You can see the company generated over $1 billion of cash flow in 2021. Then you have capital expenditures, which are investments in property, plant, and equipment. If the company purchases land to build a new store, the cost of that land and the infrastructure for the store goes in the CapEx. Then the cost is depreciated over time onto the income statement. Operating cash flow minus CapEx gives you your free cash flow, and that was really high in 2021, almost $1 billion. The company generated over $200 million of cash flow when it IPO'd, and they paid down debt every year. You can see they paid down a little more debt than they issued in 2018. They paid down about $50 million in 2019. They paid down over $120 million in 2020. And they paid down about $700 million in 2021. They're doing a good job at deleveraging their company. Let's look at the capital structure. $1.1 billion of equity, $2 billion of debt. They're 36% equity, 64% debt. Their net debt is $1.6 billion, and their WACC is 9.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $3.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.2 billion. We divide that by 91 million shares. And we get a calculated stock price of $36. They're trading at $29, so they're trading at an 18% discount. It's a buy according to the model. Simply Wall Street is much higher than me. They're at $49 a share, so they're saying the stock is 41% undervalued. They're saying it's a strong buy. In the past 3 months, 2 analysts priced this stock. The low was 24, the high was 30. Since the stock IPO'd, it's pretty much only gone up. So wherever you bought it, you could have made money as long as you held for at least a couple of months. It looks like it's almost at its all-time high. It did dip a little at one point, but it came back up. This stock went up 123% in the past 52 weeks, while the S&P 500 went up 48%. The 52-week low was $12, the high was $34. And the stock is trading above its 50-day and 200-day moving average. About 2 to 5 million shares are traded each day on this stock. 93% of the shares are held by institutions, and 46% of the shares on float are shorted. This is a heavily shorted stock. Wow. In the past 90 days, this stock has gone up 40%, while its industry went up 15% and the market went up 6%. In the past 30 days, this stock has outperformed its industry and the market, but the stock has regressed in the past week, pretty much flat. Analysts are forecasting their earnings to grow 6%, while the industry grows 31% and the market 19%. The revenue forecast is for this company to grow 3%, the industry to grow 11%, and the market to grow 10%. In the past year, their earnings grew 160%, whilst the industry grew only 29%, and the market a paltry 3%. If you invested $10,000 when this company IPO'd, you'd be at $22,000 today. That's a 240% annual return. The biggest shareholders are KKR at 54%, David Gochman, the founder, Molly Gochman, another founder, Samlin Capital at 2.35%, and last is Tiger Global Management. Let's look at their financial ratios. The average PE in the market's 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 8.6, so investors are paying $8.60 for $1 of earnings. That's a really good PE ratio. Price to sales is stock price over sales per share. They're at 0.5, another good ratio. Price to book is stock price over book value per share. They're at 2.4. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $1.1 billion of equity, negative $300 million of tangible equity, since they have $1.4 billion of intangibles on their balance sheet. Their return on invested capital is 14%, and their WACC is 9.5%, which gives them an excess return of 4.4%. Interest coverage ratios, EBIT over interest expense, they're at 4.9, so they can cover their interest payments almost 5 times. ROE is net income over equity, they're at 28%, that's a great ROE. Current ratio is current assets over current liabilities, they're at 1.2. And their current assets are $400 million of cash and $1 billion of inventory. The company does seem to be well capitalized. They had nearly $1 billion of free cash flow and $248 million of working capital, so they have $1.2 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 8 companies in the same industry as Academy, and if Academy has a number in blue, they're better than the average. If they have a number in red, they're worse than the average. So they're better in all the price multiples, a lot better. Their current ratio is pretty close to average. They're much better in ROE than average. They're about average in debt. They're one of the smaller companies on this list at 2.6 billion market cap. Average is 8.5 billion. And they don't pay a dividend. About half the companies in this industry do pay a dividend. So to summarize, I have them trading at an 18% discount. This company has been around a really long time. They have pretty solid numbers. And there's always going to be a need for their product. Sporting goods, guns, clothing, everything they sell, there's going to be a need for. The only thing we have to think about, where are people going to buy those items from? Will they go to stores like this, or will they shop online? I rank their free cash flows 9 out of 10, their revenue 8 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on a link in the description below. Thanks for watching.